Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. Today I want to give you what I feel is the most important investing stat, period. Period. Okay, so I'll tell you why, I'll tell you where I got it from. So this is from Financial Advisor Kansas City on Instagram, one of my favorite accounts, period, on Instagram, so feel free to follow them. And they posted a tweet from Twitter, obviously, from Peter Mallouk. Hopefully I'm pronouncing that correctly. I'll read the tweet and break down why I feel is the best stat ever and why it can really help you to guide your investing decisions. The market has hit yet another all-time high today, and it tends to scare off some people. This was posted on August 6, 2021. But it shouldn't. The fact is, that's the norm. The stock market historically averages a new all-time high every 19 days. A new all-time high on average, based on history and what we've seen, every 19 days. And if you've noticed, really in the last 2 weeks or so, I think we've hit an all-time high at least once or twice. And that tells us a lot. I mean a lot about investing for a few reasons. So number one, in my experience, on Twitter and on public and just in the financial advisory world that I've been doing for the last 11 years, there are a lot of people who shy from investing because they feel, well, oh, the market is too high. Oh, the price of that stock is too high. It's overvalued. And they will wait and wait and wait and wait. And while you're waiting, that stock continues to grow. And the market as a whole, based on what we just heard, every 19 days, it's a new all-time high. Yet, you're waiting. So I had a client, I won't say famously, but I had a client in 2015 that said this exact same thing. So, oh, well, no, the market's too high. It's overpriced. Market kept growing. Oh, it's too high. Market kept growing. And then never actually invested, but stocks like Nvidia, even Amazon, continued to run, and it got way too expensive. So when you could have gotten Amazon at 1,500, now you're looking at, I don't know, 3,000, 3,500, whatever the stock is at right now, and now you're trying to invest. Same thing for Nvidia. Prices on average, that's not every single stock in the world, but on average tend to rise as a whole every 20 days or so, 19 days to be exact. But every 20 days or so, the market hits a new all-time high. So number one, you do not have time to afford to wait and just hope that a stock drops down to some magical level for you to invest in. But also keep this in mind when the market does fall. I've told you guys for a while now that when you hold for a year or more, you've got about 80% chance that that stock is going to be positive. When you hold it for 3 to 5 years or more, you're talking well over 90% chance, 89% for 3 years, and above 90%, I think it's 97 to be exact, after 5 years if you're holding. This is why you usually want to be a long-term investor. Your chances of success are a lot higher. This is why I repeat, this is why I do not panic when the market drops. You've got people that I've seen that invested for a day, they lost money, they quit altogether. It's terrible, and just quit, right? Like, that's not what you should do most times. And when you're investing for the long term, you start to see these all-time highs all the time, and you really shouldn't react. This is also why I continue to DCA, where I'm investing on a regular basis, where I'm not worried about, well, the market dropped today, I should put money in today, or should I wait till tomorrow? Because it's not going to matter, right? When you do this for long periods, it's not going to matter because the market is going to hit that new all-time high. So if today was an all-time high and I invested, 2 weeks from now, 3 weeks from now, it's another all-time high, that will be that low point, right? We always say buy low, sell high. Well, if it's continuously getting higher every 20 days or so, perhaps I should invest all the time. And that's where we get to that DCA and why it makes sense. And it's why I'm not always so, I guess, adamant about you have to invest on this day, you have to invest at this price. When you're a long-term investor, and I want to emphasize long-term, you just need to be regular. Whatever regular is for you, you just need to be regular and be on it, and you're going to be fine. When you reinvest your dividends, you're going to do twice as good, right? Based on the data that we have. So relax. Like, your investing process does not have to be hyper focused. It does not have to require all types of complicated charts. If you want to do that, you are more than welcome to. If you want to trade and make things a little harder for yourself, you can. And hopefully, if you do that, things will pay off. That's the point of it. But what I have seen most times, not all the time, people put in these complicated charts, put in these complicated graphs. You put in 2, 3, 4 hours of work for $1 extra or 1 extra % of growth, And that doesn't happen 90% of the time. So you want to go for what we know works, go for a system that we know works. And then with anything extra, you can try and do those extra things. Nothing wrong with trading. I do trading. I'll do a video on one of the trades I did for PayPal and we'll talk about it, right? It can work, but again, I'll go with what works, right? Like for example, if I'm playing basketball, if I got a layup, I'm shooting a layup. I'm not going to shoot for half court because the odds of me missing that, not Steph Curry, but the odds of me missing that is a whole lot lower. So, or a whole lot higher, the odds of me missing that. So just keep that in mind because every month or so, I hear the exact same things. The market's too high. That stock is overvalued. Somebody is, Congress or president or whatever is running the economy. 19 days later, 20 days later, 21 days later, we hit an all-time high and people are quiet again. So this is why I'm so adamant about dollar cost averaging, why I'm so adamant about reinvesting your dividends, and why I'm so adamant about relaxing. A lot of people, well, not a whole lot of people, but people kind of give me flack like, oh, you wait 6 months and you don't do anything for 6 months. Yes. I sit back and collect all these all-time highs as many times as I can because it is very, very difficult to get 3 things right at the same time on a consistent basis. Those 3 things are what stock to get in, when to get in, and when to get out. That is hard to do. You can do it every now and then, maybe once a week, maybe 4 times a month. But to do that every single day and get it right most of the time, that's real difficult. It's like playing the slot machine and trying to get each of those things to line up every single time. I'm not saying it's impossible. I'm just saying it's really, really difficult for you to do. So hit the layup. You know right now, every 19 days, on average, the stock market is going to get hit an all-time high. You already know that 79% chance when you hold a stock, particularly an index fund, but when you hold a stock on average for a year or more, 79% chance that stock is going to be positive. For 3 years, 89%. 5 years or more, you got 97% chance. So what does that tell you? Long-term investing works, right? And we already know on average, you're going to get anywhere between 7 to 10% on average. Can you do better? Yes, you can. Holding stocks like Apple could help you to do better. Holding stocks like, I'm just throwing names of companies that I know and have, maybe holding something like a Capital One or Target. These are stocks I own, just throwing these out there. Google, for example, I think that was up like 40 some odd percent in the last year or so. That could help you to do even better. But get you a good company. I did a 3-step research process on how you can start to find those and write it out. It didn't have to be complicated, it didn't have to be a daily thing, but I'm telling you, the path to success is there. I know this because 1, I've done it and have built wealth by doing this, but more importantly, I've managed over $140 million. I've seen dozens and dozens and dozens of millionaire clients, and I was the one looking at, oh, this is what you're investing in. Let's make some improvements here. How did you get here? How did you build this wealth? What are you doing next? All these questions I ask and sit down and see over and over and over and over again. And the vast majority, 85% or so, do these exact things. They see the market dip, they say, oh, come Friday, deposit the check, invest in what I already have, and keep it pushing. Almost every time. Very, very rarely do I get clients who call and say, oh my God, the market dipped, sell everything. You don't see that often. And it's not because they have a lot of money. It's because this is the process that got them there. And that's how you can get there as well. I've always said this before. Got a video on this too. That the most important number is 100,000. And when you start to hit that, that's when compounding interest really gets fun. But you don't have to start there. You can start with $10. You can start with $100. You can start with anywhere in between. Start with the right habits and the right processes, and things will grow for you. I did not start with 100,000. I started with $100. That was it. I started with 100. Kept investing $100 a month. That's all I had to invest. I was a teacher. I was broke. I was fresh out of college and had student loans. That's where I started, okay? And I kept investing month after month after month, and eventually it started to grow. I said, all right, look, time to switch jobs. I just got paid less in my second job, $10,000 less in my second job than I did in my first job, but kept investing anyway. That is the process. It is a long process. It's not going to be the most fun process from time to time, but if you are consistent, it can pay off. But on top of being consistent, you got to start now. Okay, because on average, 3 weeks from now, the market's going to be even higher. So start with fractional shares, start with $100, start with $10, do it monthly, do it weekly, whatever it is for you, and start building up. My kids started off with 0. right? And I took it upon myself, put in $150 for him. Now my son is sitting on close to $5,000. Baby girl I think she's close to about $2,000. She's closing on her first $2,000, which is more money than I had at 18 when I had like 2 jobs. Okay, that compounding, that consistency is what gets you there. Okay, not chasing meme stocks. It's work for some, but doesn't work for most. Not day trading, works for some, does not work for most. All the other stuff, do that later. Okay, get your basics right, get your base formula right, and when you hit that level, then you can start doing the other stuff on the side, separate and apart from your main wealth components. All right, I ran a little bit more than I wanted to, but I wanted to make sure I got the point home. Let me know what you think in the comments, and what other videos and questions do you want answered in the comment section below. Y'all know how to get in touch with me. Comment section on YouTube, comment section on public, and then Instagram. If you email me, it's gonna take me a minute. Okay, it's gonna take me a little bit. But if you comment first, which helps me to help the video get up there a little bit more. But if you comment first, it actually gets to me a lot faster. I'm more prone to respond a lot quicker. Those who comment often know this, and they get videos based on their questions. All right, make sure you hit the like and subscribe button, all that stuff, housekeeping, blah blah blah. All right, I'll talk to y'all later. Bye.